Hey guys, welcome back to SB Capital. As always, we're super excited to have you guys here with us today. Today, I have a very special topic for you guys. Um, we're gonna talk about how to invest into stocks, but not just how to invest into stocks, the fail-proof, guaranteed to make you money way to make money in stocks, right? So, before we talk more into depth about it, if you guys have been keeping up with us and watching our earlier videos, you guys know that we primarily deal with stock options. Um, now, options are derivatives of stocks, but they're a whole different ball field of, like security type, asset type. So, and you kind of understand why a lot of people don't want to get their feet wet into options because, be honest with you, options are very risky. The returns are obviously great, but um, you could lose a lot of money very easily. So a lot of people would rather do stocks than options, which is 100% okay. Matter of fact, people that have the stomach to be able to just take it slowly and watch their account grow, those are a special type of people. I'll give you guys props for doing that. Now, what most people don't understand is that the most, you see, the idea was the stock market is like Wolf of Wall Street, right? When people think about the stock market, they think about the Wolf of Wall Street, just getting rich, filthy rich real quick. That's not true. When you think about Wall Street, most of the people on Wall Street are really old people, right? How are these old people really wealthy? Well, you invest slowly, you invest periodically, recurringly, you diamond hands, you buy the dip when you need to, and that's how over a course of a couple of years, that's how people get really successful in the stock market, right? You have to have patience and you have to just have a strong gut. And having that is not easy. The only way you can have patience and a strong gut is if you do your due diligence and you have faith in the stocks that you picked, right? So what I have here is a spreadsheet, simple spreadsheet. I already filled everything out, but I'm gonna completely break it down on how I filled it out, the whole scenario and everything, right? So we have a spreadsheet and we're trying to make a portfolio. As you can see on the right side here, this person has $10,000 in capital, right? So $10,000 cash in hand right now to invest in the stock market. Um, and then you'll see that I wrote buying power shows $20,000. Now, this is with margin, obviously, and I know a lot of people are afraid to use margin. Uh, they're afraid to get margin called and this and that. My answer to that is this is America. America, you should learn how to use debt. You should learn how to use loans and borrowed money because that's how people get rich. People get rich working hard and stuff too, obviously, 100%. But if you really want to get rich quick, you learn how to manage debt correctly. And margin is a form of debt, right? You're borrowing money from your broker to buy into stocks. So, yeah, I'm 100% in margin. I agree that you should take margin. I support margin. Um, just as long, like, it's different if you take out more I was about to say mortgage. It's different if you use margin and just throw your whole money into penny stocks, right? Then you kind of just they're crazy, but you don't want to do that. So when you want to make your own portfolio, first thing you want to do is understand how much cash you have in hand. I'd say turn on margin so you have more buying power. And for this case, I just wrote that this person's monthly income is 3,500, right? Because you know the average person makes around like 50K a year. With this person's making about 42, 45 a year. Uh, we're just going with, average numbers. And this is stuff that you have to keep in mind when you're trying to open a portfolio, right? Because you don't want to put all your money into it or too little money into it And if you end up putting all your money into it, you might get lucky and make a lot of money, or you might end up one of those people who end up losing all their money, right? You don't want that to happen. So what you have to make sure you do is you break down, like what you could afford and what you can't afford. So I wrote that this specific person has $2,000 a monthly expenses a month. It could be rent, it could be mortgage, it could be car insurance, car payments, all that stuff, all the good stuff. And this particular person saves $1,000 a month, which is very important. You know, you have to have cash in hand at all times. You don't know what happens. Even even suppose you have $100,000 in your portfolio. Yeah, you could liquidate it, but if all your money's in the stock market, you only have $100,000 in the stock market, not a single dollar in your bank account, you have an emergency. Of course, you can liquidate it, but it's gonna take days to liquidate. So always, always make sure you have cash in hand. Savings is very important. Saving money now monthly is more important than compounding your account because you never know what happens in life. And on back onto this, I wrote that this person is investing $500 a month back into the stock market, right? So this is the breakdown. We got how much cash this person has, how much buying power this person has, the monthly income, the expenses, the savings, and how much they plan on investing back into the stock market. And it's very, very important that you guys plan it out like this. Don't just jump straight into it. That's a recipe for trouble. So now, for me, these are the stocks that I chose. Um, this is this is my personal selection, right? Your list could be different either, but I'll break it down how I think you should have it, right? Like you'll understand what I'm trying to say. But when it comes to the stocks that you choose, please, please, please make sure you guys do the due diligence, right? Don't just invest into the hottest stock of the month, or like the one that you see on Twitter or Instagram. Don't do that. Just very simple. All the resources are available to everybody now, more than ever. If you guys want to open up your own portfolio, just make sure the stocks that you choose, you guys check um, the fundamentals, like the cash flow, how their earnings are looking, the CEO, the COO. You want to see these executives. You want to see the inside out of the company that you're investing into because it might look good now. You never know, 3 years later, and they get hit with a fraud case, something like that, right? These are stuff you need to keep an eye out on. So the way I do it is you want to have about 10 to 15% in big market cap stocks. What do I mean when I say that? I mean like FANG stocks, Facebook, Apple, Amazon, Netflix, Google, Microsoft. These are stocks that they're not going to grow anymore, right? They're not going to give you that exponential growth anymore. Because why? Well, because these are very established companies, right? These are worldwide, used everywhere companies, very established companies, and the amount of growth that they have left is capped, right? They have um the customer base and everything. So you don't want to invest too much of your money into that. That's just gonna be a it's gonna be very hard to grow your account like that, right? And Apple and Microsoft personally are my favorite ones. I still think Apple and Microsoft they have out of all the other FANG stocks, I personally feel like they have the most growth left, right? But you could choose, but what I say is you keep about 10 to 15% in the big market cap stocks. So you could see here that I allocated 10 shares to Apple, 5 shares to Microsoft. This is the cost. 7% of the portfolio went to Apple, 6% went to Microsoft. Good, great. Now, this is this part of your portfolio, you want it to be the biggest part, but not overly big. So this yellow part, it's growth stocks, stocks that have potential to grow greatly. And these are the stocks that you really, really, really want to invest into, right? Because These are the ones that have the most, they don't really have a ceiling yet, right? They could go as up as they go, right? But if you guys remember the February meltdown, sorry, growth stocks got hammered. So you want to be careful about that, right? You don't want to overexpose yourself into growth stocks. So you'll see over here, this is the only um, Excel function I'll use. Pretty easy. But you see over here, I have about 44% of my portfolio allocated to growth stocks specifically. I think that's fair, right? It's not bad. 44% of your account has the potential to grow 200, 300, 400, 500% over the course of a couple of years. Don't expect this, like a couple months. What you want to remember when you're making a portfolio like this is that it takes years to develop, years. So you have to be patient. Um, and also when you're looking at growth stocks, it's very important that you do most of your DD should go into studying the growth stocks because growth stocks are higher risk but higher potential, right? Whatever has higher risk has higher returns. So you want to make sure that you do the best of the best DD in your growth stocks because that's where you want a majority of your portfolio in, and that's where the majority of the risk resides in your account. Now, this is the interesting part. You'll see that I have 43% of my account in dividend stocks, specifically Coca-Cola and AT&T. You might ask why. Well, it's free money. Dividend stocks always move within the same range. They don't go up too much, they don't go down too much. You could check out the historical records, even when you want to look into the Corona drop. They didn't drop too much, right? So the reason why I have a good portion in dividend stocks is one, you get the dividends. Two, they don't move a lot, they don't fluctuate a lot, they're not volatile, so the chance that you lose money in the stock itself is very low. And three, you could write options on it, right? So that's why you'll see I have 100 and 100. Now, at first, you'll only be able to write one contract, you know, per 100 shares, which is fine. Once you let the dividends, you want to make sure you let the dividends reinvest into those shares. So eventually, within a couple of years, 100 shares will turn into 300, and 300 will turn into 500, and 500 will turn into 1,000 shares. And that way, if you have 1,000 shares, you can write 10 contracts. And writing contracts, which I will make another video about, is a very, very, very like safe proof way to make money. It's very good to make money. You it's almost guaranteed money to a point. And with dividend stocks, because they're not volatile, they don't fluctuate a lot, making money on writing premiums for that is easier than ever. And then you'll see I have the last 2% put into VIX. Why do I have that? Most people don't hedge their accounts. So, God, like let's say within 2 years, another event like Corona happens, all these stocks will get screwed, right? But your VIX will shoot up a ton of money, a ton. So like you like if you remember during Corona, if you haven't, VIX shot up a couple 100%, just the shares itself. So that's a very good way to hedge yourself. Um, Never ever go without hedging yourself. You're gonna shoot yourself in the foot. So now, if we took the whole look of it, we'll see that we're just gonna wrap it up here, right? Apple and Microsoft, the big market cap stocks, the ones that are very safe, but won't grow too much. You just want to have money in there. You also get dividends paid with Apple and Microsoft too, which you could reinvest. It's great. It's slow, easy money. And then you want a big chunk of money in growth stocks, right? Because growth stocks higher risk, but even higher reward. You can make tons of money from that. And you also want to make sure you focus a good portion amount of money in dividends because over the years, this is the point of this portfolio, by the way. It's not for 1 year, it's not for 5 years. This is the portfolio that you're going to have 20, 30 years down the line. These stocks, it will make you a lot of money if you just hold it. right? So with the dividend stocks, and I also wrote the dividend yields here. This you want to make sure you know how much the div yields are. And with the divvy stocks, you get paid divvies. They won't fluctuate, and you write premium. This is just a recipe for money. A lot of money. And you want your hedge. I chose VIX specifically as my hedge because the downside for VIX now is very little, and the upside, if we get a massive drop, is huge. Uh, so yeah, that is a breakdown of how I would do the long-term portfolio. The key takeaways I want you guys to take from this is always make sure you do your DD specifically for the growth stocks because I kept emphasizing it. I'm going to keep emphasizing it. The risk is exponentially higher than the big market cap stocks, right? So you want to make sure you're invest because a lot of growth stocks, they get confused with hype stocks, right? Hype stocks get considered growth stocks when they're really not growth stocks. So that's what I'm saying. You guys really have to do the DD on that part, and don't be afraid of doing DD. Like Google has all the answers that you could ever look for. This is why investing now is a blessing compared to any other time. And you want to make sure that you have a good chunk in dividends because, like I mentioned earlier, divvies, writing premium, and it's a stress-free way to make money. That's why Warren Buffett does it, and that's why this dude is one of the richest people in the world, right? And you want your hedge. And also, I want you guys to remember that the stock market alone will not make you rich. Um, you have to work. You have to have another source of income, a stream of income. Reason why, um, if you have all your money in the stock market, you clearly because the stock market's not going to pay you out in a month, right? So you need a steady stream of income. And if, let's say, 2 years down the line, the stock market goes down, when you're saving up money, you could take money out of your savings and put a little extra when you're in a bear market or a recession or whatever, and you could buy the dip and lower your average costs a lot. Or, not necessarily will you always lower your average cost. Maybe even after it dips, your price that you got into the stock is lower than the price it is. But that's a good opportunity to buy in, right? So that's that. I hope you guys enjoyed the video. Uh, Please like, subscribe, share. If you guys have any questions about anything, I'm talking about even personal questions on your own portfolio, feel free to reach out to us. You could reach out to us via Discord, via Instagram, and via Twitter. And we will be making a lot more videos now. I was just really sick last week. I thought I had allergies. I ended up actually really having strep throat. So, but I'm feeling great now. And you know what? I'm feeling great. I'm feeling rejuvenated. I want to make some money. I know you guys want to make some money. So let's get on this, guys. Until next time, please stay safe, stay healthy. I'll see you guys soon.